Hi everyone, I'm Benjamin and I'm here to do a video about fundamental analysis for Hutchinson Port Holding. First of all, I would like to start with the table of contents where we first have the company background followed by the financial stability ratios consisting of the current ratio and the interest coverage ratio. Then we'll move on and talk about the performance indicators which consist of the operating margin and the return on equity. Finally, we'll talk about the valuation parameters, where we have the PE ratio and the dividend yield. I've also done a SWOT analysis of the company, where it includes the strengths, weaknesses, opportunities, threats, and the conclusion as to whether to invest. For the company background, Hutchinson Port Holdings Limited is a subsidiary of the multinational conglomerate Hutchinson Whampoa Limited and the world-leading port investor, developer, and operator. The HPH network of port operations comprises of 319 berths in 52 ports, spanning 26 countries throughout Asia, the Middle East, Africa, Europe, America, and Australia. It is the world's first publicly traded container port business trust and is listed on the main board of the Singapore Exchange in March 2011. It is admitted into the Straits Times Index in April 2013. Hutchinson Port Holdings has deep-water container ports strategically located in Quanxing, Hong Kong, and Shenzhen, the People's Republic of China. It has also expanded internationally over the years into other logistics and transportation related businesses. These include cruise ship terminals, airport operations, distribution centers, rail services, and ship repair facilities. Now move on and start with the first financial stability ratio, which would be the current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay its short-term obligations. It is calculated by taking the company's current assets over its current liabilities. As you can see from the table, there is a steady increase over the years 2009 to 2011, a slight decrease from 2011 to 2012, but a sharp decline in 2013. This shows that the company is doing well when it first started, as having a ratio of more than 1 means that they can meet their short-term obligations. The reason for the decline in 2013 might be because on 2013 March, the trust has acquired 100% interest of shares of Asia Container Terminal Holdings Limited, which cost approximately up to $509 million Singapore dollars. This acquisition created synergy with the trust, other Hong Kong terminals, and the strategic expansion increases the handling capacity, overall operational flexibility, and efficiency to serve shipping. It also serves to enhance the overall competitiveness of Hong Kong port as an international hub port to compete with other ports in the region. So I'll move on and talk about the next financial stability ratio, which would be the interest coverage ratio. The interest coverage ratio indicates how easily can a company pay interest on its outstanding debts. The warning signs are triggered when this ratio becomes less than 2. As you can see from the table, there's a steady increase from 2008 to 2010, but a drop from 2010 to 2013. However, this shows that the company is doing significantly well as it stays above the ratio. Next, moving on to performance indicators, we have operating margin. It is the ratio that indicates the net profitability of the operation of the business. As you can see from the table, apart from Hutchinson Port Holdings, I have also done some research on its major competitors, being China Merchant Holdings and COSCO Pacific Limited. We can see that the margin for Hutchinson Port Limited is quite consistent across the years as compared to competitors whose margins are unpredictable, as you can see from China Merchant Holdings, from a 7% to a negative 71%, and then shooting back right up to a 76 positive percentage. The reason for the China merchant negative operating margin in 2009 could be due to the reason that consumption downcast and export strain both existed in the main economy entities, and the international trade quantity and demand for shipping businesses has obviously declined. As you can see from the table, they indicate a decrease in the operating margin of Hutchinson Port for 2012 and 2013. This could be due to the cost rising by close to 10%, mainly due to the high container throughput, increase in external contractor costs, and inflationary pressure. The port operator was also hit by a high-profile strike by port workers in May last year that resulted in a 9.8% increase in wages for port employees. Next, I'll move on and talk about performance indicators, where the first one would be return on equity. Return on equity is the amount of net income return as percentage of shareholder equity. It shows that how much profit a company generates with the money shareholders have invested. As we can see from the graph, it's considerably lower than its competitors after 2012. The reasons could be due to the low asset turnover and modest leverage. Next, we'll move on to valuation parameters, where the first ratio we have would be the PE ratio. A high PE ratio means that investors are willing to pay more to buy the shares of those companies which they think have good prospects. As we can see from the table and the graph, the PE ratio for Hutchinson Port Holdings is increasing steadily, and the growth is consistent, unlike COSCO Pacific Limited. As you can see, it almost dropped by almost 50%. This shows that investors are more willing to pay more to purchase the stocks. For the next valuation parameter, we have the dividend yield. The dividend yield is the dividend return in percentage terms of total investments. As we can see from the table, the dividend yield for Hutchinson Port Holdings is constantly increasing and doing better in terms of stability as compared to its competitors. It also shows that the company is giving its dividends out. Next, we'll move on to the SWOT analysis. First, we'll start with the strengths of the company. One of its strengths would be its global port network that holds interest in 52 ports comprising of 269 berths in 26 countries, including container terminals operating in 6 of the 10 busiest container ports in the world. It also has a natural deep water geographic advantage underpinned by long-term rights and a strong relationship with the world major shipping lines and shippers. In addition, it also has world-class facilities with national competitive advantages and superior operational efficiency, resilient and strong profitability with strong cash flow generations, as well as attractive growth prospects. Next, I'll move on and talk about the weaknesses. One of the weaknesses the company has would be it is competing directly with neighboring port operators, and that since Hutchinson Port Holdings is internationally based, it means that their competitors would have quite a number as well. The second weakness would be the demanding union workforce, as I have mentioned in my video above, that due to the strike by the union workers, the operation cost has also increased. For opportunities, one of them would be new acquisition targets, as I have mentioned earlier, one of them being Asia Container Terminal Holdings Limited, and that the US also plays a huge part in determining the total volume of containers handled by HPH Trust. This goes the same for Europe. The US economy is recovering. Its GDP expanded at a respectable rate of 2.6% in the fourth quarter of 2013, with consumer spending growing by 3.3% over the same period in 2012. This is the fastest pace in 3 years. manufacturing activities, consumer spending, and the labor market are also expected to continue to improve in 2014. The Eurozone economy got off to a solid start in the first quarter of 2014, with the economic data showing encouraging signs. In addition, the market Eurozone Composite Purchasing Managers Index came in at 53.1, registering expansion for the ninth consecutive month. The Eurozone outlook appears to be healthy and positive. Both outbound cargoes to the US and EU has also shown upward trends, and that the trade routes of Far East Africa, Central and South America are expected to grow considerably. Despite the weakening of both factory output and new orders, new export orders grew for the first time in 4 months. It is expected that China will launch relevant and forceful measures to support the economy. Another opportunity would be the carrier alliances formed by leading liners, which deploy more mega vessels to promote economies of scale and strengthen competitiveness by expanding the coverage of vessel sharing schemes such as the formation of P3 Alliance. With leading-edge infrastructure, natural deep-water channels, mega vessel handling capabilities, and scale of operations, the company is well positioned to pursue and benefit from this development and from this servicing of large shipping alliances. Now, last but not least, for the threats, one of them would include major competitors, as I have mentioned before, the China Merchant Holdings and COSCO Pacific Limited. The consolidation of mega vessels and liners coming in would also mean a shrinking throughput. There is also higher depreciation across the years due to the constant expansion of the company. One major threat the company faces would be its exposed to business risks in several different countries, which may have an adverse effect on its financial condition. The group operates in many countries around the world, and one of the strategies is to expand outside its traditional market in Hong Kong. The group is exposed to different and changing political, social, legal and regulatory requirements at the international or national level, such as required by the EU or the WTO. The company is also exposed to various regulatory risks, which includes change in tariffs and trade barriers, changes in taxation, regulations and interpretations, competition law applicable to all the company activities, including prohibition of anti-competitive agreements and practices, and as well as the law requiring the approval of certain mergers, acquisitions, and joint ventures. Moreover, new policies or measures by government, whether fiscal, regulatory, or other competitive changes, may pose a risk to the overall investment of the group infrastructure and may delay the commercial operation of a business with the resulting loss of revenue and profit. These high regulations may impact the group financial condition and result of operations in the long run. For conclusion, all in all, I think that we should invest in a company and go long. Such reasons will include the one that I have mentioned above, that it is being a market leader in the world's largest trading hub by throughput. There is world-class facilities with natural competitive advantages and superior operational efficiency, long-term relationships with liners and their customers, resilient and strong profitability with strong cash flow generation, attractive growth prospects, and sponsorship by HPH, the world's top port operator by throughput. Thank you. I have come to the end of my presentation.